Okay, excellent. Here's well, Happy New Year, happy Financial Fitness Friday. Thanks for showing up. And today is part two of personal finance and investing 101 and 201, as I say. Here's just a disclaimer, um, as as you know, this is meant for educational purposes. This is not specific advice or recommendations for anybody, but hopefully you find this useful and it helps you out in your own journey to financial freedom. If people could give a thumbs up real quick that they agree to put these, that I can post these on YouTube on the for free, so people can download. I know people they can't make it want to see these later. So excellent, thank you. And I also mentioned, like, if you there's where all the resources are right there. That's got all the free slide decks and videos. You can see them there or on the actual YouTube site. Why are we here? Bottom line, for most of us, financial literacy is never taught in school and often not at home as well. And so um, this is important because many of us start taking charge of our financial future far too late, and miss the important early years and that great compounding that can take place. And so what I'm hoping you can get out of this is the second part. The other one's already recorded. Um, for part one of this personal finance and investing, but hopefully you can feel confident, take steps, and actually make those steps to help start solidifying your financial future today, whether it's opening up specific accounts or making adjustments to your allotments as we roll into the new year, and hopefully everybody got a raise and they're not spending it all. Here's a couple of my quick money mistakes. I highlighted a couple of things that we'll kind of touch on during this topic, which is part two, and specific ones that I had issues with. One, thinking I had to study too long before I started investing, buying individual stocks by index funds, thinking that was the right way to invest, actively managed funds, and then getting scared out of investing due to a market crash. I mean, we're still in there recession, and market's been down, but for most of us, that's actually the best time to invest while the market's on sale. So here's the questions. The first one was, do you contribute at least 10% for Viasat? That's the minimum. That's a requirement to get the 5% match. They do 50% cents on the dollar up to a maximum of 5% match. So you need to put in 10%. And good, 9 out of 12 put in at least 10%, and then 3 out of 12 max out their contributions, which is good. Hopefully we can get that number up higher than 3, but I'm glad everybody's at least contributing. And there's several things I like to do ahead of maxing out the 401k contributions that I think are more important investment choices in terms of the hierarchy of where you put your next dollar, like IRAs, HSAs, and other things like that, but we'll get into that. Okay, the next question. Okay, if you don't max your 401k contributions, have you set up auto increase? One person said yes. A third, 4 out of 12 said no. 5 out of 12 said they already max it, which is good. That doesn't check with the last one, since it said only 3 out of 12 maxed it. But how the heck do you do that? I've got for at least our work on one of the slides, I'll show you. You just go to Empower, you go to the accounts page and then contributions, and you can set up. There's an easy button to hit that says add auto increase. But we'll get to that slide. It's in the bumper, you'll see. Okay, next question, number 3 is, have you increased your investments and savings more for 2023? So it's split 50-50, half increased, half have not. That's why we're doing this in January. Actually, I did the first one in December, hopefully to get more people to start allocating more if they can right now. And usually a lot of people get raises at the end of the year. And so before you start blowing all that extra money, start putting it, some of it away to make your future self in a much better situation. Okay, next question, number 4 is, do you have an IRA? Half of the people said Roth, 2 out of 12 said traditional, and 3 out of 12 said both. I have both, and I actually believe everybody ultimately will need to have both at some point, but I'm a big fan of the Roth IRA. with its tax-free growth and other flexibility that you don't find in any other retirement savings account at this time. Let's see. Okay, go to question number 5. Do you max fund your IRA annually? That's $6,000 in 2022. I put 2022 because you can still contribute for 2022 up until tax day this year, which is why I left that number up there. But it has increased to $6,500 in 2023 and $1,000 catch-up contributions for the year you turn 50 and over. So half contribute, max it out, which is great. 3 people do not. 2 say I don't know, which to me, if they don't know, they probably don't. It's my guess. Can't, since I don't have one. So if somebody doesn't have an IRA out there, that's one of our action homework items at the end of today's discussion, is opening up those accounts if you don't already. Did somebody have a question, or is it Joyman? Did you just have?
Yeah,
Go ahead.
Alan, just
Yep.
quick question.
Yep.
So for the IRA, for the 6K limit, isn't that only for the Roth IRA that has a income limit as well?
Nope. The max contribution limit combined, like you could actually have a Roth IRA and a traditional IRA, and the sum of those contributions in aggregate for each year is 6,000. So yes, there are income limits, as you mentioned, on for the Roth IRA, and actually there's income limits on the traditional IRA for those contributions to be tax deductible if you're have an employer sponsored retirement account like a 401k like we have. So but it's actually, that's the contribution limit, which for 2023 it's 6,500, and that's split whether you do all Roth or all traditional or some combination. It's just the maximum, all those accounts of 6,500 for 2023. Does that answer your question?
Yeah, I think so. Thanks, Alan.
Okay. Okay. Yep. And if it doesn't, please, let me know. I know I tend to, Jansen knows I tend to answer the wrong a question that wasn't asked at times. Let's see. Okay. Do you have a brokerage account? 9 out of 12 said yes. 3 out of 12 said no. I definitely recommend having a brokerage account as well. That's what I think of for shorter long-term savings. So that's where you don't, but you're not restricted to an age requirement like most of these qualified accounts, like the 401k, the IRAs, individual retirement accounts, etc. If anybody that's at our company that does employee stock purchase plan or has RSUs, they've already got a brokerage account through E-Trade, since that's where it goes into, and you could fund that, or you could open up a separate one. I would recommend opening up a brokerage account where you have your IRA account, which I'm a fan of. Vanguard, Schwab, and Fidelity. Any of those companies are great, but they're the best low cost discount brokers. Let's see, 7. Do you have an emergency fund, 3 to 6 months of liquid expenses? 6 out of 12 said yes at a brick and mortar bank. 5 out of 12 said yes at a high yield savings account. 1 said no, and 1 said I don't know. So good. Hopefully we can get the no to have, in the next, we're working towards getting that emergency fund up, and how much you need is very individual. But for the people at the brick and mortar bank, you're probably making like 0.0 nothing % on interest. So I would put that emergency fund in a higher savings account. They're over 3% now, and they're usually at least 10 to 20 times interest better than the brick and mortar banks. So might as well take advantage of that. And I'm a fan of Ally Bank myself. So, I didn't. I guess it didn't add that last one. The last one I asked was, are you enrolled in ESPP? And for people at our company, if you haven't enrolled in ESPP, the deadline, the window closes January 15th. So recommend doing that. And if you can, max it at the 5%. It's free money, kind of like the 401k match. Okay, I'm going to stop sharing that now. Any questions or thoughts on the poll? Okay. Well, here's the agenda. The last in December, we did part 1, which was, we covered the secret to wealth, et cetera, those items. And today we're going to go into the next part of investing the savings wisely, portfolio management, And the last couple of items you see there, let you can read. Okay, I did want to mention this though, because we talked about we're going into investing the savings wisely. But as I mentioned, hey, you guys remember what the secret to true wealth is? Um, it's pretty simple, but it doesn't mean it's easy. Spend less than you make, invest the surplus wisely, and avoid significant debt. Do that, and you'll be wealthy. And by saving, in general, I mean investing. You're never going to beat inflation by just using a savings account. So you need to be in the market for long-term investing. Saving for retirement, I think, is a poor choice of words that we use. So here's the kind of when we talk about saving and investing the savings wisely. This is basically what we're gonna go into today more specifically. Okay, saving versus investing. One first thing I always like to say, and we have been a topic already on life insurance, but life insurance is not an investment. The main purpose is income replacement to support an insured's dependents. So like really, if you don't have people depending on your money, you don't really need life insurance in a sense. Like there could be reasons for it, as that's we're not going to get into this deep discussion. It's important, it's protection, but it shouldn't be your number one investment vehicle. If you have maxed out everything already and you still have so much extra income that you need some tax haven, then or you have potentially children, special needs children, often need like permanent life insurance. But otherwise, be skeptical on whole life insurance salespeople in their graphs that are typically, I'd say, lies, showing a much better return than you're going to get. And then term versus permanent life insurance, I think for the vast majority of people, term is the best way to go because you can invest the difference in that huge cost if permanent insurance is so expensive, whereas term is inexpensive. And once you're financially independent, you're self-insured, so you don't need the insurance anymore. Wanted to go into time horizon though. That really gets into saving versus investing. Investing is long term, so it's looking at least 7 years. That's for any money that you have in the market. That's what you want to be, considering. Savings is short term, but you can use, and there's a risk. I've mentioned that podcast before. Risk parity radio is a good one that goes into um, a risk parity portfolio where you kind of might have 6 different funds that really are non-correlated or negatively correlated, so that it wouldn't give you as great of a return as typically just being all equities when you're young, but it would give you a better return most likely than just keeping it in a savings account or something like that. So for something like a house down payment, that might be a good option if you're looking for several years out. If you don't have a time horizon on the house, then I would just invest it, and then years down the road, you could slowly cash out your equities to use as a down payment. Just a thought. And then how much savings is emergency fund is really needed? Typically, they say 3 to 6 months. It depends on if you're single or married, dual income or not, how your job, how easy it would be to replace your job as well. And then as you get closer to retirement, really that emergency fund becomes much more like we're looking into buckets. It'd be more like in that short-term bucket that would be 1 to 3 years of cash equivalents. And that's really protects you against sequence of return risks, which is like we're in the case of right now. Somebody that retired, say at the end of 2021, all of a sudden we jump into a bear market, and if they had to sell their equities right then, there's no or during that year, you never can recover that. So you'd want to just use your cash, your short-term cash equivalents, and that's why you want it for a longer amount of time when you're into retirement, so that you can ride through those the tough bear market times without selling off your equities, and then you can still rebalance and refill those buckets as needed down the road as the market recovers. Anybody have any questions here or on the last one? Okay. Okay, and how much money do we need to retire? Actually, Shama, you answered this pretty well last time. Um, there's, different. Some people say like, oh, you need 5 or 10 million. It totally does not make sense at all. Shama, what was the example you gave that how much income you need, or how much money do you need to retire? Do you remember what your
Um,
answer was last time?
I don't remember.
I think you said 70 or 75% of your
Right,
income,
right.
which is a good one. I hear often 80%. Those are tough. The thing about that is because your income's changing constantly. So um, more than income replacement, I prefer, you really need to figure out what are your expenses going to be in retirement. And that determines how much you actually need. Um, and then we'll quickly go through this. We talked about this last time, but this is just a thumb rule. But if you know if you can calculate your expenses, and it's gonna vary probably when you're in retirement, because you might have an estimation when you're first going in, and then over the couple of years it might vary noticeably, because maybe you're traveling more than you anticipated, etc. So it might be a little bit higher. But if you have a good estimate of your expenses and then you multiply that by 25, that's the number, that's your financial independence or financial freedom number, which is based on Bill Bengen did a great study, and then the Trinity study followed it up, the similar thing. And they found um, that 25 times your annual expenses, basically that would equate to a 4% safe withdrawal rate. Like I said, this is just a thumb rule, but this is based on inflation. So say you had $1 million, 4% is 40,000. Granted, that's not much money for, especially California, but for an annual income. But say just for easy numbers, 40%, 4% of $1 million, that's $40,000. And then you adjust that each year for inflation. And you can withdraw that additional money. And over a 30-year retirement, 96% of the time they never ran out of money. And over half of the time they actually ended up with more money. It really varies. I don't believe in just using a 4% safe withdrawal rate as a thumb rule, or as a actual withdrawal strategy, but it's a good idea of figuring out how much money do you need, what's your pool of money that you need to be comfortable that, yep, I can retire, and you can make adjustments. So
Alan,
yes,
just want to make few comments.
sure.
Couple things are important to remember. Your expense in the retirement.
Yep.
The first 5 years or 10 years, depending upon when you retire, far and most important is your house paid off.
Yep.
Second one, you will travel really lot compared to later part of the life. So your expenses are going to be way higher the first few years compared to the remaining part of your retirement.
Yes.
The tool may not be sufficient in the beginning,
Right.
which it should be, but it may not be sufficient in the beginning, and then it may be okay later part of the retirement.
Yep. Shama, that's an excellent point. And there's often, maybe you guys have heard that before. There's the go-go years, the slow-go years, and the no-go years in retirement. So just as Shama was saying, when you're early in retirement, probably doing a lot of travel, hopefully a lot of international travel, etc. And you're going to spend a lot more money there. And then those expenses will start decaying away. And just like you said, also the house payment, hopefully, a lot of people try to pay off their house before retirement, but that's not always feasible, especially in California. But that'll eventually go away as well. The mortgage and interest payment. Then is the expense that will go up will be medical later in life. So that's something to account for. There's a great retirement and IRA show. They do this. They account for all these fixed expenses, kind of like food, utilities, housing, healthcare, and medical, and they want those all controlled by fixed income, and increasing at a certain inflation rate for each. But that covers all those like they call it the minimum dignity floor. It's more like minimum lifestyle floor, like things that you always have to pay for. And once you've got those covered, though, the rest they consider your fund money. which I think is a great idea, how much you have in a fund money. And that way you can spend that when you want. So when you're young in retirement, you can go get that RV, go do all that travel, because they find too many people do not, the better savers are terrible about spending. They just keep saving and not living their life. So great point, Shama. Appreciate that. Anybody else have any thoughts? Okay. Okay, now we'll get into more, how do you actually invest for retirement? And the next lecture we'll have in February, the lecture discussion, is going to be on those specific retirement vehicles, where we delve deep into each one and all the income limits, et cetera. Since that's what I found after I did this one initially, people didn't quite understand all the differences. But here's your, tax advantage requirement, tax advantaged retirement accounts, which are like the 401k, your health savings account if you have a high deductible plan, and the individual retirement accounts. Everybody should have these in addition to a 401k as well. Non-tax advantaged accounts, you pay taxes now, so they're like brokerage accounts, but these are great. Too many people have all of their net worth in just retirement accounts, and they don't have the ability to. It makes it more challenging to retire early, or to come up with, pay for larger expenses early. So I think it's important to have a little bit of each. Crypto has been crushed, as kind of, I would say, expected. But that's been, another thing that you can't get typically in retirement accounts either. Anybody have questions here? Okay. And these are, like, you'll see, I just put these as pictures. These were the vehicles I created for the different retirement accounts, vehicles to use for retirement. And we'll just quickly go through there, but each of those have a reason why is that. The 401k, this is your largest one. This is why I call it the dump truck, because there's so much money you can dump in this account compared to other things. The IRA, the 2023 limit for all contributions is up to 66,000 this year. That's an increase of 5,000, and that number is 73,500 for people with catch-up contributions from age 50 onwards. The normal ways to contribute are elective, deferrals, which were limited to. We'll go on the next slide. We'll show that limit of 22,500, and then a company match. But where you could potentially get that much larger number, getting close to 66 or 73,500, is these other either profit sharing or after-tax contributions, if your employer allows for those. Unfortunately, we don't have that currently in our plan. And then if people have a side business like a solo 401k, you could put up to 25% of profits into there. Okay, here's the actual contribution limits, and I showed last year's and this year's. That way you can see they did make up for kind of the inflation and increasing the limits. So went up $2,000 per year for everybody from 20,500 to 22,500. Also, the actual catch-up contributions increased from 6,500 to 7,500. So people 50 and over can contribute just from their own elective deferrals from the paycheck, $30,000 a year to the 401k. That's almost 5 times what you can do to an individual then retirement account. And then, as mentioned, though, here's what a limit. There's 66,000. There's still $43,500 that could be contributed somehow potentially to this 401k, and that's where I think of really the mega backdoor Roth comes into play. Okay, here's just a quick example of showing employer match and maxing the contributions, and this is assuming somebody makes a healthy salary, but it was just for simple numbers. They made 225,000, and you get matched. They put 10% away. That would be 22,500. The employer match is 5%, 11,250. That employer match, at least for us, if you have catch-up contributions, also includes the catch-up contributions. So you can get higher than a higher match, based on your catch-up contributions. But that total is either 33,750 or 45,000. That still leaves, over $32,000 extra that is under this 401k umbrella, which is why I'm trying to get us the ability to do after-tax contributions and in-service distributions, because that's money you could, if you had the ability to save that additional money, you could, it would be after tax. You've already paid tax on it, and then within service distributions, you could roll it into a Roth 401k or IRA and greatly increase your Roth contributions for retirement. Any questions here? I kind of went through that pretty quick, but okay. After the 401k, and we'll see in the hierarchy, but I don't recommend everybody max that out until they get the match and then go max out the IRA. And the Roth IRA is what I call military grade because of its flexibility. And we'll have a slide on that later. But there are specific income limits for these accounts. And I put both 2022 and 2023 as mentioned from the poll. People, if they don't have an IRA yet, they can open up one for 2022 and contribute up to that $6,000 or $7,000 if they're 50 and over, up until tax day, which this year is April 18th. So that's why I put both of those and those income limits. But the income limits have went up pretty noticeably in 2023. Roth IRA limits still too low, I think, for married. Ridiculous, but there's still there's ways around that with the backdoor Roth conversion. But they finally increased the IRA limits. These should be at like $9,000 if the government had accounted for inflation over the years, but at least they finally started increasing it. So 6,500 for the Roth, 7,500 for catch-up contributions for people 50 and over. Notice for the traditional IRA, there are income limits, as I mentioned, that are very stringent to be tax deductible if you have a 401, if you're participating in a employer-sponsored retirement account. For 2023, and that includes us, if you contribute to the 401k, you can only do a traditional IRA and deduct that tax money, which then it would be a nightmare if you've got some tax that, some that's you've already paid taxes on, and then all the earnings you're gonna have to pay tax on. I'd just rather have it all in the Roth if I could, since you can't deduct that anyway. If you didn't have an employer plan, the traditional, there's no income limit on making tax deductible contributions. But I'm a big fan of the Roth. And you'll see why here in a minute, but many people will need both, because especially if you get over those income limits, like on the Roth IRA, you can contribute a non-deductible contribution to a traditional IRA and then convert that to a Roth IRA, and then it grows in the Roth. It's the Congress is trying to close that down, but it's still available. And that's what I recommend, and I've got a little strategy later you'll see. Okay, I put this out by this for our employer. It doesn't, but many of you might have a spouse or know somebody that has works at a state worker, schools, hospitals, or nonprofits. They have a 457B, which is they usually have a 403B and then a 457B. But this is in addition to like us having a 401k, they can contribute that same amount to this other account that doesn't have any age requirements. So they can contribute this money, and then they can, whenever, say they want to retire early, say at 50, they can start using this money from that day on, tax or depending on whether it's Roth or not. But they could pull this money out all penalty free before 59.5, unlike the other accounts. So it's incredible. You think about it, that's doubling your qualified tax advantaged accounts in a single year if you have that access to this type of account. Any questions there? Okay, health savings account. This is one that's used too infrequently and typically used improperly. Um, you the health savings account numbers went up. You see, I have 2022 and 2023. They went up to 3850 for single, 7750 for a family, and that it also shows the minimum deductibles and out of pocket max. But the you have to be in a high deductible plan, which hopefully our company does provide that as an option. But the key to it, HSA, the best way to use it if you can spend that money on today's medical expenses, but the best way is to invest that money, pay for your medical expenses out of pocket, and keep those receipts, like keep it in a Google Drive or somewhere where you just scan and keep all those receipts, and then let that money grow for many, many years, and you can reimburse yourself down the road. And it's triple tax advantage, meaning when you put the money in, it's free of taxes. It's also actually quadruple tax advantage because you also don't pay FICA taxes on these. So not only so you avoid taxes going in, then it grows tax deferred, and then if you use it for medical expenses, it comes out tax free as well. So it's like combining both the benefits of a traditional and a Roth account, which is amazing. And then if you didn't have it for medical expenses, when you turn 65, you could still use it as like a traditional IRA. You'd pay taxes on those gains, all that taxes would be deferred, but then you'd have to pay tax on those if you'd use it for non-medical items. One of the cool things that our account also has, our company has, we also have an FSA, which is a flexible savings spending account, and that's one of the use it or lose it. So if you take, you save money on taxes if you use that, but that money has to be used this year for medical expenses. But that can cover all sorts of things, like even like Band-Aids and stuff like that. But even if you have an HSA, you can have an FSA. It's called a limited use FSA that we have, and you could use it for dental and vision. And so that would be one way where you could use if you wanted, you didn't have enough money to pay for all the out-of-pocket expenses and let your HSA grow. This would allow you to let that money grow, and you could still take advantage of tax-free FSA to cover dental and vision expenses. Did that make sense? Any questions there? And if different companies have different policies on that, that's how ours works. So you'd have to check with your own company whether if you have an HSA, if you can also take advantage of a limited use FSA. Not everybody lets that happen. Any
Quick
Yep.
Quick question, Alan. Does the HSA follow the tax year as well? So April.
Nope.
April.
It's these both go calendar year. Like the 401k and the HSA go by the calendar year. Actually, Christian, for us it might be different. I'd have to check because I think it goes with when our with our fiscal year. So I know for the because the FSA starts in like May is when you start contributing because of how our calendar is set up for our fiscal year. So it might be actually, but it's a calendar year that doesn't go where you can contribute from January 1st up until tax day of the following year, like an IRA. It is a 12-month period, I guess. But I'd have to check on the HSA when that actually starts or not. That's something we'd have to check with wellness on.
Okay, so you're gonna ask them, is open enrollment period or calendar year January 1st?
Or is it not even that? Because I know the FSA starts May 1st.
Right. Okay.
And I think it's probably May 1st is when those happen because that's when our new plan starts. Even though we do open enrollment in December, the actual plan kicks off. We're on the same plan from the previous year until May, and then that new plan kicks in. Does that make sense?
Okay, yeah, it does.
So I think that's probably when the HSA and the FSA contributions start. I know that's the case for the FSA. If you're retired military, you can't take advantage of an HSA, unfortunately, but granted, having healthcare for life is a is a better benefit. But I would like to have an HSA as well. Any other questions here? Okay. Okay, Social Security. I just put this up real quick. Just hugest, largest increase in a long time. But for us that are working still, notice they've increased the taxable earnings so that they can cover these increases at 9%, over 9%. So we're now, if people make up to 160,000, that can be taxable to Social Security. Any wages above that is not, but that's a $13,000 increase in taxable Social Security taxable income starting in 2023, which I put as about almost $1,000 extra tax a year. Okay, and there just shows quickly, hey, here's the how much of an increase, the Social Security is compared to historically. The only last time was back in the late 70s, 80s when inflation was out of control again. Okay, here's why everybody should have. I'm just gonna open up these. Have a Roth IRA, as mentioned. It can be used as a backup emergency fund. You don't want to use this money if you can't. It has to be an absolute emergency, but you can always pull your contributions out from the Roth IRA tax and penalty free. So if let's say you're trying to build up your emergency fund and you also want to contribute to your Roth, well, you could contribute to the Roth and consider that as part of your emergency fund for now. That way you don't miss out on the yearly contribution limits. You know what I mean? Once April 18th, once tax day hits, you're done for that previous year. In April 18th, 2023, you can no longer contribute to 2022. So if you only put $2,000 in and you missed $4,000, you can never make that up again. And Roth, that tax-free earnings, that's something if you can max it out every year, you definitely want to. The other thing, it has no required minimum distributions, which is huge. Right now, all other accounts that qualified accounts, 401k, both traditional and Roth, and traditional IRAs require a certain percentage of withdrawal starting at age 72. They're moving that hopefully with the next Secure Act to 75, but that's not till like 2030 something. But those, by not having required minimum distributions, you have the flexibility to spend your money when you want to spend your money and how you want to spend your money. So it's great. And then there's also the ability for Roth conversion. And really, I think of that in the gap years. Once you stop working, or you could even do this if someone's taken a couple years sabbatical or something, they could, when their income's lower and their tax rate is low, start taking that traditional either 401k or IRA money that's hasn't been taxed yet and convert it to Roth. Then you'll pay taxes on that money, but you're in a lower tax bracket, and slowly move that money into the Roth account so that it'll grow tax-free forever. And you can build up that Roth bucket that too many people have lacking. Since Roth just start for people that are a little bit older. Roth started only recently, and many 401k plans didn't have a Roth component until like 2013 or so. Any questions here?
Alan,
Yes.
can you roll over from 401k to directly to Roth, or it has to go through the traditional IRA?
So I would, in general, Shama, you could go, if you have Roth 401k, the Roth works great, and there's no taxes because you've already paid those taxes as well. Personally, I would control it. I would move that money traditional to traditional, and then adjust a certain amount, because you want to do a certain portion to maintain it within a certain tax bracket each year. So you don't want to convert typically the entire amount. You want to put each year, you take a certain amount of that traditional 401k money and move that into Roth, keeping in a low tax bracket. And then you just keep repeating that over and over again until you got as much as you want in there. Did that answer your question? That makes sense?
Yes.
It's a much more controlled way than just trying to go traditional right into a Roth and then paying a ton of taxes, which I don't recommend. But everybody should open up a Roth IRA and they're a 401k, the Roth 401k portion, and put at least $1 in, because it starts the 5-year clock. You need that 5-year clock. Even if you're at 59, that 5-year clock still comes into play for earnings to be pulled out tax-free. So if you haven't opened up a Roth IRA, open it up, start part of your Roth 401k and get money in there just to at least get the clock going. I'd recommend, with our low tax rates right now anyway, probably want to be putting a decent amount in, but that's for 2 lectures from now when we go over, again, traditional versus Roth and lifetime tax management. Okay. Wow, I'm sorry, I'm back and forth. Okay, there we go. Okay, here's why I think people need both a traditional and a Roth IRA. Sham already kind of hit into it, just talking about taking a traditional 401k to whether to go into a Roth IRA or a rolling a traditional 401k into either a traditional IRA or a Roth IRA, which is something that's a good idea often cases, as once people retire from their company. But traditional, as mentioned, that you defer taxes today, but those, if you have a employer sponsored account that you participate in, like a 401k, you saw those tax earnings to be tax deductible. The income limits are very low. Roth IRA is tax-free earnings and growth. As mentioned, it's got limits, but there's and that's all based on Maggie, which we'll cover what that means, the modified adjusted gross income. But there is the ability to do, as mentioned, the backdoor Roth IRA conversion. Congress is trying to get rid of it, but it's still available. And how that works is you contribute a non-deductible contribution to traditional IRA, convert it, and it'll sit there for a couple of days till you can move it, but then you can convert that to a Roth. Bam! You pay taxes on any growth that's happened, but then it grows in the Roth account, tax-free forever. The important thing that I highlighted there is this is assuming you have no other money in the traditional IRAs, and this is aggregate of all your traditional IRAs. So if you've rolled over from a previous employer a bunch of money into from a traditional 401k to a traditional IRA, then the backdoor doesn't work. What you can often do is roll that traditional IRA money into your current employer's 401k plan, and then then you don't have any money in the traditional IRA, and then you can do the backdoor Roth conversion. But next slide goes into what the pro rata rule is. But simple strategy, if you're above the income limits, I think is, contribute monthly to an HS, high yield savings account, January of the current year. So say for 2023, now you've got all that money already in the savings account. Immediately put that into your traditional IRA, and then a couple days later you put it into your Roth IRA, and voila, timing the market is better than timing the market. So you'd have all your contributions for the current year sitting in the Roth account in January of the current year. Make sense? Okay, and here's the pro rata rule. So quickly to make sure people understand that. If you have money in a pre-tax IRA, you have not paid taxes on that money. And I'm giving an example up here just for simple numbers. Say you had 94,000 in there. Now you make that, say this is for 2022, you make that new after-tax contribution of $6,000, and it's a non-deductible contribution. Then you try to roll, now you have a new traditional IRA balance of $100,000, right? Well, that $6,000 of after tax, it's like creamer in a coffee. Once it goes into the cup, it all mixes together, and the IRS sees that 94% of that money has never been taxed. But when you just try to convert, say, that 6,000 that was after tax money, that's not how the IRS looks at it. They look at 94% of that money has not been taxed, and you will pay taxes on all that money. That's why pre-tax money in a traditional IRA ruins the back door. So and it doesn't matter if you have a separate account or not. The IRS sees all your traditional IRAs and it aggregates all of them. Make sense? is an important concept to make sure you understand.
So this
Hey,
is only useful to really young people that haven't started saving in an IRA.
Actually, well, no, because Janet, like I said, it's actually, and this is one of the problems. This is where my third lecture goes into of Roth versus traditional, because too many people look at just taxes today, and they should have been doing a Roth IRA early on. But if
Right.
you have 401k that you rolled previously into the IRA, you can roll all that money. Our company does that. You can roll all that traditional IRA back into the current company's 401k, and then now you don't have anything in there, and you can always move that money back and forth because they understand, I mean, they understand where that's a separate kind of pool of money, so you can still use this. That's just how you'd have to do that. Does that make sense?
Yeah. Okay.
hey,
Um,
Alan.
Yep.
So what you said, if you have a traditional IRA, you roll it over to the 401k, make it zero for all traditional IRA.
Yep. For all traditional IRAs. Yep.
Then you are putting that 6,000. Why would you put it in the IRA and not a Roth IRA?
Because to contribute directly to a Roth IRA, if you're, you cannot do that. If this is only, Shama, if you're over the income limits for Roth IRA contributions. Make, let me see here. Let me go back real quick and,
One moment, okay? One moment. Sorry
okay.
about.
So the problem though is once you roll it into Viasat's 401k, you're stuck with the investments you have under the Viasat 401k. You can't get the money back out of there till you leave Viasat. Right?
No, that's not true, actually. So yes, you're right on the first part. Absolutely. You're stuck with whatever the investments they have. But I mean, there are some, I'll show some of them. There's plenty of enough decent ones. But, and you don't have to wait till you leave Viasat though. You can roll that money back into the traditional IRA later.
Oh,
Yep.
okay.
So that's what I mean. That's what I was saying. That money, it's like, that money isn't suddenly stuck in the 401k. That money you can move, you can roll it back and forth, basically.
You just somehow have to keep track of how much it's growing, or you can only move the principal back out again.
Now you can move, I guess, you can move the entire amount out. It might be a little bit challenging. And at some point, Janet, is it worth it? Just contribute to the Roth 401k, granted,
Yeah,
I don't
which
have
is
the
what
Roth
I
IRA.
do anyway,
Okay.
but I'm trying to look at this because my investment advisor keeps trying to get me to convert, and I'm like, but the tax is going to be so high on
Yeah. And yeah, exactly. And that's the problem. And that's why I think the Roth conversion strategy is great, really, for the gap years. So before you start, that's where pushing out Social Security, we'll get into this actually, Social Security as late as you can, and not collecting, and before RMDs kick in, that you want to do those Roth conversions when you're not, your income's low, after you stop working, your income's lower, bam, then you start rolling, heck, in like the 24% tax bracket, that's a big window there that you could do after you stop employment, and you can move a lot of money each year before turning 72.
Okay.
Yep.
Janet, did I cut you off? I don't mean to.
No, I got it answered. You go right ahead. Thank you.
Okay, and if it didn't answer your question well enough, please, let me know, and we can continue on. We're going to run a little bit late. Hopefully people have some extra time, but these are important concepts, I think.
So the previous slide, Alan,
Yep.
it is for if you are over the limit to contribute to the Roth.
Exactly. If you're not over the income limits to contribute to the Roth, then just contribute directly to the Roth IRA.
Got it. Thank you.
Okay. Yep. You're welcome. Okay. And here's just when we're talking about these different incomes, this is kind of like quickly looking at from, top down when you're looking at your taxes. You got your gross income, then adjusted gross income, which is your gross income minus adjustments, which comes down to your taxable income, which is your AGI minus the standardized standard or itemized deduction, and then some people have this qualified business, deduction, but very few people do. Maggie, the difference between that is you have to add back certain tax exempt things like municipal bonds and stuff like that. And Maggie is what actually determines eligibility for Roth, deducting traditional IRAs and some, the premium tax credit. So, but most people don't have many municipal bonds, at least early, where Maggie's any different from Maggie equals, Aggie, the adjusted gross income. And then this is where we're talking about the Roth conversions, Janet. Like, this is kind of what I think of the retirement trifecta. It doesn't have to be a third and a third and a third, but you want some in each. Too many people have this where it's all traditional. And as mentioned, that was not people's choice for many years because Roth came around the Roth IRA was 1998 it had started, and many 401ks started maybe later. But this gives you absolute lifetime tax flexibility, and why during those gap years, if you have so much in a pre-tax account, you want to move some of that over, and it just gives you absolute flexibility for lifetime tax management, because those RMDs can kick in later and push you into a high tax bracket forever. Because the RMDs just keep getting more as time goes on. But these are, like I said, the traditional IRA is a always taxable bucket. Your brokerage account is maybe taxable. That's what I call the tow truck, because it helps pull you to that retirement age when you can use these other accounts, even though there are ways to get money out of qualified accounts before 59 and a half. And then your Roth, which is never taxable. And so you want to get this because that just provides so much flexibility into spending how you want, but not maybe going into too high of a tax bracket. And then we talked
you can
about,
also defer. You can also defer taking Roth 401k money a lot later than the traditional, right? Or
not yet. No, it's the same. The RMDs are the same age, but it's not taxable at least.
Okay. I thought
it's
they
not
were talking about making some change, but
they
I'm
are
confused.
talking about that. Potentially the Roth 401k will not have RMDs, which would be great, but that's not the case yet.
Okay.
So hopefully that'll happen. I'm glad you brought that up, but that's not the case. Right now, it's still just the Roth IRA. That's the only thing that, and so really how that affects you when you think about it is you don't pay taxes on it, but then once you have to pull that money out, you can't shove it back into a Roth account then. So now it's the best you could do if you didn't need to spend it would be going into a taxable brokerage account where you'd be constantly paying, taxes on interest or capital, distribution, dividends, etc. Make sense?
Is there also, I mean, it's a little morbid, but if you die and you leave the money to your children and stuff like that, have they changed it where they've got to start taking the traditional IRA a lot sooner? They can't roll it over, or they're thinking about that as well?
No, so they got rid of what's called the stretch IRA, and there's specific rules, but basically for kids, all the money has to be withdrawn within 10 years. They don't have specific, like and we'll see, they're probably going to adjust that as well. The IRS has been kind of confusing about it, but you could take nothing for 9 years, but that 10th year, you've got to withdraw all the money from that IRA.
And pay all the taxes on it.
And pay all the taxes, exactly. Unless it's, yeah.
And were they talking different on the Roth though? The Roth 401k, that money would be treated a little differently?
Well,
I mistake that one too.
It's all of those. The stretch
it doesn't treat all the same.
Is all treated, yeah. And so that's unfortunate. But the government wants their tax money.
Their money, yeah. Okay, thank you. Sorry to interrupt.
No, not at all. This is why we do this. I appreciate the participation, and hopefully, if you have a question, I know, many other people do as well. So hopefully I just know the answers. Or okay, let's see. Okay, here's, like I said, this is too often the case where people have all their money in traditional accounts. And another morbid idea, which is sadly true though, is if people are married and then the spouse passes away, suddenly they're in single tax brackets and can instantly go into much higher tax brackets. for the rest of their life. So that's another reason for converting to Roth. I do think you want some of each though, because why not all Roth? Because if you've been using all Roth all your life, then you've paid way too much taxes for too long. That's where you strategize and convert, use a tax deferred traditional approach when your income's too high, and then start converting when you drop down to a lower tax bracket. Okay, quickly. Too many people think of investing should be boring. Actually, it's not speculating, it's not gambling or trading in general. Here's the official definitions of. I'll just let you guys read that, but of investing, speculating, trading, and gambling. But the opportunity is a greater likelihood of being profitable investing. That's the only one that's a greater likelihood. And that's stocks, bonds, real estate, or investments because they have positive expected returns, unlike other things. Speculating is where there's some intrinsic value that you think someone will pay something more, like crypto, that's precious metals, etc. Trading, day trading, I know people do that, but 99% of the people lose money. There's some good statistics I'll show in the next discussion on common investor biases, just showing how pathetic. And men are the worst, way worse than women, because they think they're overconfident, think they're smart about investing, and their returns are much worse annually by trying to time the market and thinking they're smarter than the market and trying to pick specific things. So my thought is, you're not Warren Buffett or one of the few unicorns. Just buy the whole market, buy the low cost broad-based index funds, and just let it buy and hold, and you will be happy long term. And then gambling, obviously. Some people want some fun though. That's why I say you can do 5% of your money in speculating, but the rest should be just boring broad-based index funds, and you'll be very successful. And you can't ruin yourself if you take 5% of it and play your cowboy account or whatever. Okay, here's my thoughts on hierarchy of saving and investing. One, everybody should have $1,000 cash. If you don't, get that right away, and then get the employer match up to the max. Pay off high interest credit cards, high interest debt, debt in general. But that is not typically, that's not homes, that's not student loans, etc. That's just like ones that you can't beat the return on. Determine your emergency fund needs. That varies person to person. But typically they say 3 to 6 months, and then as you get closer to retirement, you want a larger cash bucket. My next thing is ESPP, because you get a minimum 15% gain in 6 months. And then you could use that money, you could cash that, and then if you couldn't already put money into the max in the IRA and the HSA, you could use that money towards those type of accounts as well. And then hyper accumulating wealth, the taxable brokerage account for shorter long-term savings that doesn't depend on an age requirement. Max your 401k, real estate investing, and then paying off your low interest debt like mortgages, student loans. Any questions there?
On the ESPP, do you recommend selling it every 6 months instead of stupidly holding it like I've been doing?
And Janet, what you can do now, like is I wouldn't sell those. You can sell specific lots, but yes, you don't want more than. Well, actually, I'll keep going. Yes, I do think you don't want more than 10% of your. I've heard up to 30%, but no more than 10% of your company's stock of your net worth, which is probably not there, but you can. Our stock has not been like a Google or a Netflix or and it's not going to be. Just sell it. And now that you've already had that, sell all your stuff that's already qualified, that you've already had for 18 months, and sell the losses, because it's all the same now. And so you can use that to offset other capital gains, maybe.
Gains.
Okay. And then reinvest that, diversified. Sell that, buy the total U.S. stock market or something like that, index fund.
Okay.
That's my thought.
I have been doing it because I didn't realize at first when I hired into the company that our 401k match is in Viasat stock.
Yep.
So every June when we get matched, I don't know if everybody else knows this, but I go in and I sell it right away because I don't want it in my retirement fund. But I didn't realize that for about a year, that they were not matching what we put into, which most companies seem to do.
Yep.
So
And there's when it comes into the order of which to sell, though, you'd sell you'd want to sell the ESPP and the RSUs first, actually, because there's an advantage in the 401k of NUA, it's net unrealized appreciation. So if you had that money in the 401k, later on, when you're done working and you pull that, you could distribute that money instead of paying all income taxes on that. You'll pay just capital gains taxes, basically. So you get a preferred tax rate on any appreciation of that. So that's a kind of advanced level discussion, but it's something, like I would just hit the ESPP and RSU, sell those first before the company stock, because there is some advantage there in the 401k.
Okay, see, well, I'm glad you told me that because I've been doing everything backwards since. So. Thank you.
And so passive versus active funds. Passive funds are what I recommend, and they've taken off. Jack Bogle with Vanguard started these, and it's basically just designed to copy the performance of a market. You don't have an individual trying to buy and sell, so it's much more tax friendly. They're much cheaper, lower expense ratios, and they win long term. You see the fact 3 out of 55 actively managed funds outperform the S&P 500 index over 30 years. They just don't win. And if they win early, they're going to lose. By the time you know about them, and Morningstar Ratings has these great ratings, don't look at the Morningstar Ratings. By the time you get into it, that's when they'll start losing against the market. There's a return to the mean. So I'm a big fan in general of passively managed, passive index funds by it's actively managed. There's some that are active that are getting better, but so long as their expense ratio is really low, because with the expenses they usually cost, they lose. Okay, and we'll go into those expenses. So transaction fees, granted, those are going away now, fortunately, but the expense ratio, the next item, is the biggest thing. 1 to 3.5% for actively managed funds, that's common, versus 0.01 to 0.3% for index funds. Huge difference there. A 2% over 40 years, a 2% difference in return, you lose half of the gains, assuming a basic so just thought of Shama. You lose half of the gains based on like a 8% rate of return. It's pretty crazy. So expenses do matter, and actively managed funds, they're also trading, buying and selling. So you're paying all these additional taxes like capital gains taxes as well, that lowers your overall return. So that's why I'm a big fan in general. I do have one active fund, but it's 0.25% expense ratio, and it just matches the index, that small cap value index, better. Here's our index funds, and that when you go into Empowered, you can see what all these growth expense ratios are. Fortunately, our target retirement funds are very low compared to other places. They're Vanguard ones, but I think anything you see, I kind of put green, yellow, and red. Anything less than, I want less than 0.25%. But you see a lot of these are, these active funds that we have in there, very high expense ratios. And then I circled some green ones that I like, that you kind of do that, and you've got the whole basically globally diversified market if you pick those 4 green ones with very low in expense ratio in general. I just don't like the small cap equity fund expense ratio. And so there's where, when you look at all your money, you've got your 401k, you've got your IRA, you've got your brokerage account, etc. So I'll put more small cap into my IRA and brokerage account, where I can get a better expense ratio than here. And because it's all about the totality of all of them, and asset. So I can pay less expenses and still make a better return. But this, you can go in, into your account and your investments, and you can change your investments. I do it myself because the amount they charge is not worth it, in my opinion. It's pretty easy and enough to diversify. Any questions here? And this, I won't read through all this, but really, there's here, I'll go to the next one, but I like the US total stock market account for a lot of large percentage of money. You want some small cap value because typically that wins long term, but it's more volatile, maybe some emerging markets, but just some balance of these, and then you periodically rebalance. But here shows why I say you want small cap value. The last decade it hasn't done well, but historically you see its return is way better than everything. It's like a 12% versus 10%. You talk about 40 years, that's a significant amount of money. So you do want some percentage, maybe kind of declining as you age, but you definitely want small cap value in your portfolio. Okay, here's Janet's this employee stock purchase plan. And this is where I kind of get into, hey, sell right away or not. Like in your case, since you do already have some, I'd sell the stuff that's already qualified because it's a better tax treatment, and sell the stuff that's at a loss, since all the stuff it's all the same stock price now. So might as well sell it for a loss, and then that can offset. You could maybe do tax gain harvesting on other things that have done well, down the road. Granted, I know everything's been down this year, but I think you know what I'm getting at. And then just diversify into more of a broad-based index fund instead of sticking with one company. But I think just say max 30%. I've seen that. I think max 10% is at the most. I think that's too much. I knew several people that had lost basically all their net worth in the 2008 Great Recession by having never moved their money out of the the individual company stock, and the company went under, and they lost their job, they lost their net worth, everything. It's terrible. Okay.
That's kind of why I was wondering about the 401k money too. But I mean, I don't think that's going to happen with Viasat, but I guess if you were in a risky company, then don't leave it match. Okay.
Exactly. And you can, Janet, you could convert some of that anyway, but that's only the match money anyway, really, so it's not, it is risk. It's definitely a higher risk, but that's why I was just saying, in terms of order, I would sell the ESPP and the RSU stuff first, because there is a tax advantage for this net unrealized appreciation for company stock in a 401k. Okay, and here's kind of going back to that hierarchy. This is for people that need, hey, what do we do? What do I do now? Okay. If you haven't already, make sure you have that $1,000 liquid immediately. Get that 10%, get that max match if you haven't already. It's free money. You wouldn't walk by $20 or $1,000 and not pick it up. So don't, make sure you take advantage of it. If ESPP, it's an immediate 15% at a minimum. So I take advantage of that right away, get to the max. And that's open until the 15th. That window closes if you haven't already enrolled. If you are enrolled, it just stays where it's at right now unless you make a change. Open the IRAs, and I like I said, Schwab, Fidelity, or Vanguard. Set up automatic investing. That's what you need to do. We're emotional animals, and we make stupid decisions. So put it on automatic and keep your emotions out of it. Open a brokerage account, same place as you have the IRA. And like I said, make it automatic. That's key to success, in my opinion. And just basically things I like to buy. And then buy and hold, be patient. As in the secret to wealth, he mentioned the best thing you can do is almost just put as much money as way you can for 40 years. And when you finally look at your account balance in 40 years, you'll need one to be sitting down and a doctor probably nearby, because you'll have so much money you won't know what it might cause yourself a heart attack. And the last things, I'm not a big fan of budgeting, but everybody has to do it at least once to make sure, see where your money's going and where it should be. Okay, and then here's just the net worth, like and where you should be. Formula I like to use. This is comes from the Millionaire Next Door, and what they have, and the Money Guy show actually came up with the prodigious accumulator wealth for people that are under 40, because it's hard, when you start at say your 20s to start earning income to actually make this. But basically, I think the prodigious accumulator wealth is 2 times your age times your income divided by 10, and that determines it. Gets you an idea of where you should be at least in terms of the wealth building. Doesn't matter how much income you have if you don't have money invested and saved. And then here's the net worth like tracker. I recommend everybody do at least do it quarterly or annually. This is the one that I have that, and it breaks up your net worth into, this is just example numbers here, but it breaks up your net worth into the various buckets, so you can see what part of yours money is tax-free, what's taxable, what's traditional, and then what portion real estate, etc. And that's free download for that, available if you like, and with instructions. And then here's the homework as mentioned. Go in and look at update your contributions percentage. Got a raise, don't spend it all. If you don't have the IRA already, open it up. If you haven't funded 2022, you got 4 months to do that, and then set up automatic investing. And then something you should do every 6 months or so, review and cancel those unneeded subscriptions that you've forgotten about. And also, always, every year should verify your beneficiaries for all your accounts. I've heard some horror stories about that. Say somebody gets divorced and they never change it, and they pass away, and doesn't matter. That divorcee is going to get the money if they haven't changed their beneficiaries. Okay, and then here's just some basic questions, and you guys have any additional questions? I know we ran over, but there's quite a bit of good questions today. So
I have a simple question, Alan.
sure.
Why aren't you mentioned that you aren't a fan of budgeting?
Yeah. Well, no, I think you need to budget. I guess good question. I shouldn't have said that. I budget initially, and I think you need to, and when you do that, you need to look at a whole year's worth of expenses, because otherwise you might forget about auto registration, all those, like 6 month or year long, things you only pay once a year. But I set that up, and what I prefer to do is pay yourself first, Jansen. So I know what I need, minimum expenses that I have, but then budget will help you gauge where you are exactly, and what you minimum can't do. But then set up based on that, you set up your investments, and you have everything go out already. And then you've already met your savings goals, and you can spend what's left. And I just don't like to go in every month and go and look at take the time to look at how much I spent on each single category. That's just me. But it's important to do. I just don't want to do it every month, if that makes sense. I'd rather figure out what my expenses are, what I can save, maximize, settle that up ahead of time, and then just put it on automatic, and then let it ride.
Okay, so it's just personal.
Yeah, it's just personal. I guess some people have, like, what they say, that's what Paula Pant, she calls it the anti-budget, which is more like what I do is, you save and invest in all the things that you want to already, and then what you have left over, you can spend. So you've already you know, you've already taken account, you've already set up your savings and investing. Whereas, and that's why you have to pay yourself first before you spend your money. You invest that money, you know, before you go and blow it on, you know, whatever, things, you know, material items that you don't necessarily need. So you set up all that, all those accounts, all that money going out of your accounts ahead of time, so you don't ever see it. Okay,
Thank you.
and yep, you're welcome. And here's other topics that are potential topics. I highlighted the next one we'll be doing in a couple of weeks on common or investor biases, and we will be repeating the retirement investing vehicles, you know, all but the top one that are crossed out. We've already done those, but we'll continue to repeat those each month. So early February, we'll do retirement investing vehicles. Then, and I'll try to do a new topic as well as a repeat of these each month until we've gotten through, repeated and refreshed all the current ones. And then if you have other ideas of topics or questions, let me know or shoot them in the Slack channel as well. Thank you.